Hey guys, so today I'll be basically teaching you everything you need to know about liquidity, how to trade liquidity, how to target liquidity, what liquidity is, what you need to know about liquidity in order to be profitable. I'll show you how to predict where price will move, and this is without going too deep into algorithms and microstructure and the specific reasons why this is not happen. If you guys want to and you request it, I'll make a future video explaining in depth literally what liquidity actually is. It's a little bit complicated, it's a bit tough to grasp, but simply I'll just be explaining how you can use it in your trading. You don't need to know everything what it is, so I'll just give you a very simplified version. Um, I know TGR just made a video about it, but there's some things that I feel like were not very clear, and in general, a lot of people teach it, and they are teaching you how to use it, but it's a bit hard to understand, at least in my opinion. So what is liquidity? Liquidity is just the ability to place orders in the market at ease, or just there's more available orders, and there's just more the order book has more limit orders above you and below you. Whenever you place an order, there's two types of liquidity: active and passive liquidity. Active liquidity is market buys and market sells when you place an order, and passive liquidity is stop losses or limit orders or breakout orders. Basically, any order that is not meant to be filled yet and it's placed at a specific price. And active liquidity is when orders are actively being placed. So when limit orders get hit, they turn into active liquidity. And when you buy or sell something with a market order, it's active liquidity. And so, because there's an equal amount of buyers and sellers at all point in the market, that's what market makers are for. They provide liquidity. Then, whenever you buy, let's say you buy at this level right here. That's just for no reason. 25866.25. If you buy here, right, then what you're looking for is an equivalent sell limit. So that's why the sell limits at every market tick that are placed. This is your bid and ask, or for like this is what basically your order flow is. And for market to place in your order, it moves up to the next available liquidity, to the next available limit orders, meaning that it will have to move up when you buy in order to reach those limit orders. This is how market makers make money. They make money off the little change, a little difference in the price between the tick. That's what they make. So whenever orders are active, they move the market. So that's from liquidity providers. Now market movers, or the whales, when they want to make big orders, they need, in order to make their order, they need a large amount of the equivalent order. So if they wanted at any place to just buy a lot, they're going to start eating up all of the sell limits, and price will drive up, but it'll fill them in as it's going up. Meaning, instead of buying everything at, let's say, 25800, their buys are going to stretch up, and they're getting large spreads and large buys, which is why they don't want to buy like that. So when they wait for price to reach a point where it hits a lot of liquidity, a lot of resting, like a large amount of resting stop orders and limit orders, and from like it's a small percentage of trading is all a small percent of trading is retail. It's other large amounts of orders. Then they can get filled at the same at the same price level, and it's more efficient. And so price targets liquidity because that's what is needed to fill orders. And that's basically what liquidity is. It's just all the resting stops and limit orders that are either provided to or placed by institutions that participants in the markets, in order to move price and to allow price to be filled and allowed for the trade between a buyer and a seller to happen. So liquidity is everywhere, but what we are trading is where there's more liquidity, or like you have liquidity at every level, but it's provided and it runs out. It's finite, and as liquidity is getting ran out, it drives price up and down in the search of more liquidity to fulfill orders. So this is where it gets to what we know is where, if we know that when we're trading, we're looking for liquidity, market movers, the big smart money is looking for liquidity to place in their big orders to make money and buy low and sell high and move the markets. What we want to know as retail traders, without getting too in depth, is where is the liquidity, and then how do we trade off of it? So where is liquidity? It's above and okay, I'll change the font to be smaller. It's above and below highs and lows. Why? Because that whole range has already, there's just more liquidity sitting under this where people put their stops, their invalidations. There's a lot of limit orders sitting in that area below. Previous day slash week slash month slash session highs and lows. This is specific, like the previous day has the whole previous day of buying activity of orders waiting. Same goes session, week, month. These points have an enormous amount of limit orders waiting, and that's why price targets it on the larger time frame, such as this daily low. And now the limits, the orders were from this point downwards, and as price hit it, until it ate up all the sell orders and was able to fill them, it took 250 points from the bid, like from the liquidity the market makers provided to fulfill all these sell orders, and then it also fulfilled buy limits, like where there's sell limits from everyone else, smart money has buy limits, and they got fulfilled here, and that's why price reversed and drove up. During a continuation, it takes a smaller amount, or it moves up from the absence of sellers and just a small amount of buyers. The buyers trying to buy it at a quote unquote low, and then when it moves up, suddenly now there's buys to fulfill these lows. It took up buy side liquidity that the market needed in order to keep going down, because the market needs liquidity on both ends. It goes from, okay, I'll get into this soon. Where's liquidity, and then I'll get into it. It's in highs and lows. Inefficiencies slash imbalances. I don't think I spelled that right. Let's just say imbalances. And and sorry, I'm recording this at 1 in the morning. Imbalances. And why? Because an imbalance is basically what happened was price ate so much of the, why is it squiggling? Price ate so much of all the pending liquidity that was here, and it left a vacuum. So the nearest liquidity on the other end, on the buy side, sits above that vacuum, because when price sat here, there was liquidity under it and liquidity over it. And when price quickly takes all this liquidity, there's liquidity sitting here, but the other liquidity sitting up here. That creates this vacuum, and price often likes to rebalance to a point where it can fill in buy side and sell side just as easily until these get replenished, which is why a displacement often has retracements to it, but why it also shows order flow going this way, because at the end of the day there had to be a push to get that displacement, which is why in a manipulation leg you would like to see imbalances, and then this is why price retraces to fair value gaps before moving, even if you're bullish and they're a bearish gap. But even like this fair value gap is still a strong draw. Price will eventually go here, but it's also all based on time frames and all that. So there's liquidity and imbalances. A lot of limits are placed there and created there after they were taken on the other end of the spectrum. And so highs and lows, and specifically we have equal highs slash relatively equal highs and lows. Why? Because that was imagine like a high with highs and with, like, let's say a buy side liquidity, and you have a high that equates it but never took any of those orders or slightly under it. Now you're adding up orders, and then there's external slash internal. So on two ends of a certain dealing range that you're dealing with based on your time frame and based on the structure you're trading for, because price is fractal and it moves and it does it and it behaves like this in all settings. There is, in a trend, price is always going from internal to external. So in an uptrend, it keeps taking up the higher extreme of the external, pushing the range higher. In a downtrend, it takes out the lower end of the external, pushing it lower. And in a range bound sideways setting, it's going from external to external to external to external. But on the way, it takes out internal liquidity, because there's not only liquidity hiding up here, but now there's liquidity that was created, and this should be, you should pay attention to this for the opening next week. And we're on the 4 hour, which drives higher end order flow. These are relatively equal lows. These are all points where there's limits sitting. So they're sitting here, but when they reach here, there's more here, more here. There wasn't like, if a wick it was like this, all this area of limits were taken and price and the main orders will be down here. It's much more of a high resistant liquidity point. But because these are adding up, this is low resistance liquidity. So you have high resistance slash low resistance liquidity, where in low resistance liquidity you have liquidity spread out across, or trendline liquidity. In high resistance you have a lot at one singular point that's harder for price to get to, but will have a stronger reaction off of, while inversely low resistance price usually continues. It doesn't have the strongest reactions to these, and it sets up for continuation and allows price to seek a lot of liquidity, or just has a very strong displacement if they're close enough to each other and price is able to reach from one to another. So again, liquidity is above highs and below lows. Specifically, these are high resistant liquidity zones. Sometimes they form next to each other and create equal highs, relatively equal highs and lows. Liquidity is found internally in the structure and externally, and it comes in high resistance liquidity and low resistance liquidity. And also in imbalances, there is a vacuum of orders, and it pushes the spread farther, creating a draw on liquidity. So now we covered where liquidity is, and why price targets liquidity, and the different types of liquidity you must know, including everything I just showed you. Let's know how to trade liquidity. This is the part that matters. This is the part everyone cares about, and this is probably why you clicked this video. So we go, how to trade liquidity. So this is what you're gonna do. Price goes from buy side to sell side. Price goes from buy side to sell side, from internal to external, and vice versa. So I'll write this internal again, unless like this, buy side, and it goes from buy side, internal, external, external, internal, and at the end of the day, price goes for draws on higher time frames, and yeah, so that's where price goes. There it goes. So how do you trade it? Well, this is an example of what I would do. What you look for is you have a time frame that you trade on. Let's say it's 5 minutes. So on the daily, you see that price is delivering off of this, and it's bullish because it's currently delivering off of this high resistance external liquidity, sell side liquidity, meaning that, and clearly there was a reaction to it, and I'll show you the difference between a continuation and a reversal. And so it goes up and it hits internal liquidity, it displaces above it, it seeks down, so on this leg it creates an external high, it takes the first wave of internal and it takes the liquidity, it creates a displacement through it, this fair value gap, and then it retraces, fills in this area, goes back up and fully fills this area, displaces up through it, and now we're chasing this level, right? And so throughout the day, we might be we're actually creating low resistance liquidity because we hit the last internal, and now we're delivering off of this daily for value gap, and we're going up to this next internal point. So first we delivered off here, right? And then we reacted here. So let's just call this internal buy side liquidity 1. So from buy side, we went to daily for value gap, which was sell side. And then we go, and we also take this previous day low. So previous day low. And then we go up and we're taking this. So now I think after here, we might want to fill all the way into this fair value gap. We might, right? So we have this daily sell side imbalance, buy side inefficiency fair value gap, which will be buy side liquidity because that's what got filled in here. And then price will likely retrace. I think it'll take this low resistance liquidity, all these lows, and it might even retest this internal low that was created, right? And then go up again. That's what I believe will happen, something similar to here. It might even fill this fair value gap right here, which it actually has two volume imbalances, which is a suspension block if you watch ICT's newest videos for 2025. And then on the 4 hour, you see that price does the same thing. It always rebalances from internal, external, internal, external. So how am I trading? First of all, let's just look over here. I'll give you 3 examples. On Wednesday, so we're bullish right now. Sorry for suddenly switching so much in the charts. So on Wednesday, I believe this is Thursday. Or was Wednesday? This is Wednesday. I thought there was a 4 hour gap. I think I'm missing it. Okay, I don't really know what I was missing. Maybe it's 1 hour on Wednesday. Nope, I have no clue what I'm missing. Oh no, I'm thinking about my trade on Friday. Okay, sorry. So on Wednesday, you can see that overall we are bullish. If order flow is bullish, we're reaching a high time frame bullish target, then you're going to want to prioritize longs because the markets are being moved up to that, they're being drawn to that major point of liquidity, right? Now, within them, they're always looking for buy side and sell side, but we're looking to keep breaking the external high and taking the internal high. So on Wednesday, we had, what do we have on Wednesday? It's hard. Let's go straight down to the 5 minute because I'm just confusing myself and I'm losing it. On Wednesday, we had created right here after midnight, after Asia, took the Asia high. We created this, let's say external high buy side liquidity, and then we have a relatively equal London high, and we also, when we went down here, we took out some internal liquidity, right? And so we took out like this low, and then we retraced up, we took out the internal high here, we reversed down to, and we created a relatively equal low. So this is relatively equal London lows, right? And we go up, we fill in this fair value gap right here. So we have a 5 minute CB fair value gap, and we sweep these lows. Now, notice something. When we took this low out and this sell side from, and we traded off of this fair value gap right here, this is what I forgot. There was a 15 minute fair value gap right here, very important to note, and there's actually a BPR. When there's a fair value gap through a fair value gap, it's called a balanced price range, and price likes to draw here. but let's just use the fair value gap just to make it simple and not to throw in new concepts. 15-minute BISI, buy side imbalance, sell side efficiency, fair value gap, or a bullish one. And we also have this point of liquidity, and we have this liquidity right here in this gap. Important to note. I think it's higher time frame gap too. So as price, well, I hate that it does this. As price trades from this sell side liquidity into this 15-minute bullish fair value gap, creates a low, it goes up, it reverses, it confirms order flow bullish, and at the first internal high, it hits internal buy side liquidity. So this is internal buy side liquidity. It takes these orders and it sells off. And again, now when we inverse, why people use inverse for value gaps, because this displacement shows that we have very strong bullish pressure, and then when we inverse it, it shows that the orders got the reverse orders got placed, and now we temporarily switch order flow the other way, and that's the direction market's moving. And inverse for value gaps are just showing you the change in the state of delivery. And so now we reverse down, and we do not take out this low. Now we're engineering liquidity here. There was sell stops here. There's more sell stops here. We didn't take out this low. There was not enough orders created. So price, what does price do? It seeks out more internal liquidity. It's not going to take this high because this is protected and there's not as many orders here. And right here we seek out the internal liquidity, and we go down and we sweep these relatively equal lows inside this fair value gap. So already an area that we are providing more sell side liquidity. And how do we know this is the manipulation leg? Because we created an imbalance going down. We have a 5-minute what got inverse fair value gap. And what confirms a liquidity sweep versus a continuation? Again, it really depends on the circumstances on where the overall order flow is going. I would assume that because we're overall bullish, that most of the time we're going to take sell side and go up on a big extension. When we take buy side, it depends on the structure. It really does. So here, and depends, you have to think about it. We are going from liquidity to liquidity, and we're providing what the market, and we're reading what the market tells us. These relatively equal lows, which is session low, session ended, we take them, we confirm that we're switching order flow, we confirm that the orders were taken and the institutions filled their orders based on the fact that we displaced back up. Creating a fair value gap shows even more displacement, and market goes up. Now, at this first internal high, what happens? On the lower time frame, I don't want to switch to 1 minute, but we go down and up. At this high, we trade through this high, we hit this relatively equal high, and it's kind of weird. We made this really close equal high to the external buy side. So we didn't take out the external yet. And so when we reverse down here after not hitting the external, what did price do? It seeked all of the liquidity it could without breaking this more external low, and went up, and now created equal lows here. And as it's going up and fulfilling this big void and using all the liquidity built up, it finally took these highs. And then based on the time of the day, there's low institutional activity and we don't go there. And so this is how you use highs. You're drawn to them and you trade off of them. And it happens on every time frame because the orders are all being placed on the smallest time frame and they are present fractally throughout. I'll show one more example. On Friday, here we have a previous day high. So very strong draw on liquidity. Previous day high. And without trying to make this video too long, I'll speed through this. And I'll show a model of AMD. So here what we have is low resistance liquidity or trendline liquidity. Low resistance liquidity. Why? Because all these lows are not sweeping each other and they're just accumulating one after the other. Also important to note, this was the day that we had 4-hour fair value gap. So 4-hour busy for value gap. And let's go to the 15-minute. Again, we have this big internal low, internal sell side liquidity inside this 15-minute fair value gap, 15-minute busy fair value gap. This is not hindsight. This I traded this live. I made a video analyzing from around this time at 2 a.m. what I believed would happen, and then I continued that video after this whole move. And this right here, there was a level around like right here, which I guess I'm on the 4 hours, I can just around the 15, which was, no, it was this level right here. So this major level, I think it was this one. Yeah, this major level that I marked in the middle of November got swept completely. And this is what I mean. You could literally predict where price will go. It took out the major internal. Like, you can tell the difference between an internal low like this or like this versus this low inside of a 15-minute gap where price sweeps, and then after price sweeps it goes all the way up here, and then after it goes back here, it returns back to internal, from buy side to sell side, internal to external, and vice versa. So you have this previous day high. But what you also notice is during a proper accumulation phase, you see higher lows and lower highs, meaning that we're creating liquidity on both ends. And what happens is the manipulation leg, which will be a displacement candle, a big candle, and live and displaced, took out this liquidity right here, this buy side liquidity. Oh, I'm on caps. Buy side liquidity and previous day high. Now, without getting into it deep, there's a concept that you double purge where you take it, and then when you retrace, you purge it again. And then this is the true protected high, and you can tell this is the true manipulation because of the strong displacement here, meaning here orders got taken, but there was a lot more orders up here, and this is where they truly got all stopped out. And the what's it called, the institution's buy limits were definitely up here, probably around the 25,750 level. They use these numbers, and this is when the orders truly got filled. We inversed the displacement. We retraced because of the absence of the buying. Like, this is the absence of the selling, and the orders actually getting placed. This is the absence of the buying. Happens. Again, all these limits got taken, so they're up here. Price naturally draws to rebalance before the activity, like, it continues. And so I entered off of this gap. You can enter off this candle close. I enter off the retracement. And then what did price target? One, you target the low of the manipulation leg, because the manipulation leg had a lot of orders created, meaning that under this specific low there's a lot of stops. And then there's this major low in the low resistance liquidity right here. And then there's the start of the low resistance liquidity run. There's the 4-hour gap, and then there's the 15-minute gap. And so what you can see here is this is a proper reversal. But a continuation would be such as here, when it hits this major low, this internal low, but it's not the target. This low is not enough for price to now continue up to its major target. So what does it do? It reacts off of it, it even displaces off of it, but it's a fake move up. It's another manipulation move. And this down move right here that inverses this fair value gap, right? I know it's not drawn properly. This is how you trade continuations. Trading right here can give you a really good entry, especially when you know this was a manipulation move, and you continue. You continue off of this because you have more liquidity down here the price is going to grab, and you can see, like, price just swept a major buy-side liquidity target. This is a big sell-off, and the fact that the sell-off didn't happen yet here and there was more accumulation just shows that this is the first sell-off, there's more reaccumulation, then the second sell-off into a key level where price then reversed a crazy amount all the way up here. Now, why was there so much displacement? Because it was just one-sided buying, and the liquidity to be provided, it ran all the way up here straight because there was not enough liquidity provided here. There was not enough liquidity provided in this whole price range, so it ran all the way up here until enough of the opposite side was balanced, and then suddenly had so many sell orders taken that price went down and had to look for buy side liquidity, and then it ended up being balanced and there was low institutional activity, and this is what happens. So I hope this video helped clarify how to properly trade from one end to another. Liquidity is more about reading the market. It's about how you enter and leave. You want to hit a sweep. You want a confirmation like an inverse fair value gap, and you need to have higher time frame narrative and all sorts of other concepts that I will go over. But I hope this video helped you understand liquidity better. And any questions, and if I did not clear, if I wasn't clear about something, then please leave in the comments and explain to me, and I will make a maybe better video that's much shorter. And yeah, thank you very much for watching, and I hope this helped you understand even a little bit better.